If you've been following my work, you know that we've been talking about risk. That's what we do. We manage risk. We're portfolio managers. Two rules: make money, and number two, which is more important than anything else, is don't lose money. Now, we're in a jeopardy position right now. I've talked about this for almost 3 years. It's a long, long time. Gets fatigued after a while, but we're getting to the end, so I can literally see a bull market in real estate. But let's talk about what's going on right now. And you need to be ready. If you are not doing this, you are going to get snowballed and steamrolled. Now, you can see commercial. We've been talking about commercial and the commercial problems for years. For years, it triggered our timing models and our liquidity models. And you can see it. I'm going to go over a couple of graphs, excuse me, so that you can see them yourself. But let me open this up a little bit so that you can take a look at this. We have been talking about the fact that a commercial crash is underway, and that doesn't really affect too terribly many people because commercial is such a small group of people. But it's going to probably trigger housing as well, and it's probably going to trigger some major problems in banking and lending. And of course, we have a big shadow banking group that's going to get their eyeballs ripped out because this is what's going on. We have $1 trillion of commercial loans that are yet to be refinanced. And of course, they're going from much lower rates to much higher rates, and the vacancies have literally exploded. Now, these buildings are sold on what the income it produces. The more income it produces, the more money you make. Particularly, and it depends on what your alternative investments are. When you're looking at alternative investments, they're only giving you 0 to 1 or 2%, and you can get 4, 5, 6% from a real estate transaction. Well, real estate looks great, but as those alternative investments increase in return, well, it diminishes the value of a lot of properties. And what's happening right now is we're seeing multifamily, which was built a year or two ago, and that is coming to lease up. And the pro formas, when they said, "Oh, we're going to get 2,500, 2,800, 3,000, 3,200 bucks a month for a one-bedroom apartment," and this is what the lender agreed, thought that was going to work. And of course, that was in 21 and 2022. It takes a couple, 2, 3 years to get these projects up and running, and now they're coming to fruition. Now we have 42,000 units that were built here in Phoenix, Arizona, and they're completing in the last 18 months here. So we've got a lot of units, and they're struggling. They're just struggling like mad to get them leased. And they're finding they're not getting anywhere near what they thought they would on their pro forma. And the value of these buildings is dropping like a rock. So who does this affect? Well, it affects everyone that invested in that apartment group, because they're not sold individually. They're sold in big groups, big real estate investment groups. You got REITs that buy them, single, entities, limited partnerships buy them, and the people that finance them get hurt. And we're going to talk about that because we may have seen a trigger last week. I'm going to go over this last Friday. Today's Monday, so it was like Friday. And we're going to talk about that. Now we need it, already we've got a crash underway in commercial. Already happening. It's a long ways. It'll be completing fairly soon, but it's going to be a devastating completion. And that's, it starts slowly, then all of a sudden it just goes down. Well, we're getting to the end of that. So what we're seeing is that we've got commercial foreclosures are up 117% year over year. And we're getting 625 commercial foreclosures a month. 625 a month. I've been talking for years that 5 to 10 towers, we're talking 40, 50, 60, 80-story buildings, were at jeopardy of being foreclosed on or becoming delinquent. We've been talking about that ever since we saw our models go off, and that's underway right now. You cannot open up any real estate advisory video and not see that that's underway. So what's the ramifications of that for us? We're investors. Now, I'm going to tell you, you've been following my work. I've been telling you, get out of the way. This is a huge risk. It's a huge cascade of problems coming down. And I've told you to get out of the way. If you need to sell something, sell it. It might very well be too late right now to do that. If you're in housing, you got to talk to your broker and find, because the housing is underway and it's starting to cascade. And this may be the trigger for the cascading for housing. So let's go through and tell you how these two are related with when we start talking about commercial, because they are very, very much related. You bet they are. Let me go to my next slide here and let's just take a look and see how these things work. Now, look at, we've been talking about these are cities that are at risk. Bad governance, bad high taxes, a lot of crime. Chicago, certainly one of them. You can't pick up the news without that. I was in Los Angeles the last couple of weeks. Lots of problems in Los Angeles. And I'm hearing San Francisco, Seattle, Portland, New York City. New York City's is in the news with some really bad news that maybe this is going to be a very, very anti-business administration. So you have to wonder, what are you doing in New York? What are you doing in New York City? If you've got investments in New York City, you are at risk. Portland, Washington, D.C., Philadelphia, we have talked about this is just the tip of the iceberg. And we're talking about big buildings, but also commercial buildings. So strip centers and multifamily are very, very much at risk with this. It's going to get better, by the way. Now, look, I just got this out of Federal Reserve electronic data, and they're talking about rates. As rates rise, the commercial real estate delinquencies increase. So we went back 10 years and look what's going on. What coincidence, as interest rates start rising, what happens to delinquencies? And of course, we're going to talk about that, but this is underway. And you can see this red line. This is the total. You can see this is in commercial offices. And of course, this goes into the banks, right? This really affects the banks to a great extent. And we're seeing these delinquencies. They're not catastrophic yet, but the values have increased incredibly more. There's a whole lot, when you finance a building, and you're financing for maybe double what you did 4 or 5 years ago. So the risk compounds every time you do that. Now look we got this from Nightingale Associates for Q3 office vacancy rates. How do you make any money in Atlanta when your vacancy is 25%, Austin 29%, Charlotte 25%, Chicago 25%, Cincinnati 25%, Dallas 25%, Denver 26%, Fairfield County 27%. Here in Phoenix, we're at 27%. And of course, we're going to round us off at San Francisco at 33%. Now, let's be realistic here. How do you possibly make any money when a quarter of your building is empty? So that means that the revenue that you've got coming in is not there. You plan on it. You told the lender that this is what we're going to get, and you probably did an appraisal on that, and then all of a sudden you find out that nobody's coming to the office anymore, and they don't need all that office space, so you have all this vacancy. We got 25% less revenue. That decreases the value of your building. If you're used to making $10 million and now you're only making $7 million, your mortgage is probably $7.5 million. Well, that means you're losing money each and every month. Means the value of this building has just plummeted. And of course, it's happening everywhere, all across the country. It's a direct relation. Go back and look at my videos. If you like my videos, give me a thumbs up, subscribe. Let me know what you see in your marketplace, because not all marketplaces are created equal. Some are going to do just fine. Others are going to do not as bad as others. So I'd really like to hear what you're doing. But please support the channel. We're not going to come and try and sell you anything, But YouTube, for some reason, when you give a thumbs up and a subscription, they just think that's great. Let me go to my next slide here, and let's just talk about that. Let me open it up so you can see a little bit, and we'll go from there. Now, this is going back. I love the Federal Reserve Electronic Data Center. So you can see that this is the interest rates and price index, which really tracks the total value of commercial real estate assets in the United States. You can see it peaked. It peaked about a year in front of housing, and it's been coming down ever since. So it's almost retraced the entire price gain from 2020 when we started to get the explosive phase of real estate. I'm going to tell you, I think that this arrow probably is going to extend just down here. The pendulum never swings back, but they've erased all of this. So if you bought a property up here and the values are down here, you are in deep trouble. Deep trouble. And I'm going to tell you, we haven't finished here. Now, there's going to be opportunities galore. This is where you make just tons and tons and tons of money. This is where we make our fortunes. This is where fortunes are made. But it's on the back of someone who's just taken a beating. And you don't want to be that person that's taken a beating. We've been telling you all along. Jeopardy and risk. We're risk managers. One of the things we do, risk management. Risk is really, really high. We have not put any capital out. Maybe we've done 1031 exchanges, of course, I've told you that. But we haven't put any fresh capital out for almost 3 years, since June of 2022. And we've got a lot of cash sitting on the sideline, and we are going to clean up. Now, if you think that I'm all wrong, look what Warren Buffett is doing. He's got $380 billion sitting on the sideline. What do you think he's doing that? You think he just likes collecting, 3% or 4% from the treasuries? He is waiting. He just made some strategic buys in the housing industry because builders dropped about 60 or 70% in their stock offerings. And he thinks there's going to be, so housing is going to come back. This is the cool thing about this, is housing and commercial will come back, maybe at a diminished level, but at a diminished level, if we buy at a diminished level, we can make fortunes, literally fortunes. And that's what we're looking to do. Now, I've been telling you, I think interest rates are coming down and coming down fairly significantly. And I think prices are coming down. You can see this. Just look at this chart. You can just see this. This is the price of commercial. If you'd have bought up here, you are in trouble. If you bought here, if you bought anywhere along through here. Now, we've been telling you, we do valuations like crazy. We are very, very conservative. Remember, only 2 rules: make money and don't lose money. So this is coming down, and I think it's going to continue. Let me go to my next slide. Now, you can see this. Now, here's one of our concerns. This is one of the things I saw Friday. Maybe a lot of people missed this, but for the first time in a really, really long time, the bank injected liquidity into the repo purchase overnight, the largest in 5 years. Look at this spike. This is overnight liquidity. They gave the banks, $5 billion or $29 billion. So they put a lot of money in all at once. Now, why did they do that? That's a trigger, guys. That is a trigger. Why did they do that? Because the banks are running out of money. So when you finance a building for $700 million and you only get $350 back, or sometimes only $250 or $200 million, you lose $300, $400, $500 million on a transaction. That capital disappears, gone, gonzo, no longer around. And of course, this triggers your balance sheet. Now, if you follow my work, in March and April, I saw what I thought was a credit event in Europe. So we may be looking at a credit event here in the U.S., and this is going to be a trigger for the recession. I think the recession is coming really quick. I mean, I believe we're in it right now. You can see employment coming down. You can see, Amazon's laying off all kinds of people. Everywhere you go, they're talking about layoffs. People are getting very concerned about their jobs. They're not spending. You can just see retail's getting hurt. So we are already in recession. This may be the trigger for the big decline. And I'm thinking we're looking at this next 60, 90 days. I think we've got major, major jeopardy. Now, after that's over, we are going to make a fortune because we're going to have removed all the risk. Or, well, I shouldn't say all. There's never all, right? Most of the risk is going to come out of the marketplace, and we're going to start buying once again, and we're going to get phenomenal buys. You can be part of this, but we need to know who you are, and if you want to work with us, because we've got some protocols we need to go over with you, and give us a call. Well, we'd love to discuss, go over your portfolio, and see how this works. If you're good for you and we're good for you, we're gonna make a lot of money. Let me open this up, and I'll go to my next slide, and let's just try and finish this up so we're not here all day long. Now, I think that we are going to come, and I think that this crescendo is coming. We're already seeing it. It's going to get worse and worse and worse. That's why I think we're going to go below 2020, 2019, I think we're probably going to 2017, 2016 prices on commercial. That's pretty severe. That's really severe. And look at this. Now, I've been telling you, now most everyone we talk to is here in housing. Now we are in the affordable home space. That's where most of our investments are at, is in the affordable home space. It's been great for us because there's an affordability issue, right? People can't afford to buy a new house or a house. They can't afford to do it. We already own the houses and we're renting it out to them. So our portfolios are really strong. My personal portfolio is 100%. We're full, have been full for a long time because people can't buy homes. So we have a built-in tendency. So we want to provide homes for that affordable home space. And I think that we're going to have a chance to buy them. And we're going to want to buy them in just absolutely incredibly strong growth areas. If you follow my other videos here in Phoenix, we have the AI chips. You can believe that. How lucky is that? We've got the AI chips being made here in Phoenix, and we have the Taiwan Semiconductor. That area is going to employ, and it's already up and running. It's not it's already here, and it's working right now. They're doing NVIDIA, and they're doing AMD and Intel. So they're making these chips. And there's a whole group there. They're going to be employing 62,000 high-paying jobs, and they're looking for people right now. I mean, it is just like a very, very good job market. So that's where we're at, and we think it's really, really good for us. Let me go to my next slide here. So this is where I am at. If you are going to have an opportunity here to change your life. Now, if you need more income for your retirement, if you want to change your career, if you want to travel, you can go anywhere. This is one of those few times, and maybe you're going to get 3 in your entire life with which to do this, and it's coming. It's not here yet, but it is coming. And I am wildly, wildly bullish 2 years out. So I think we go into recession from here. We're already at now. I think it's going to be a pretty severe recession, and it's going to go until probably 2028. So we got 18 to 24 months from here, and then we're done, and we're going to start buying pretty soon, and we're going to pick up these properties that nobody else can afford. We're going to buy them at a very affordable price. So listen, if I can help you in any way, I'd love your business, and come give us a call. Let's sit down. Might take an hour, hour and a half, cost you a couple of bucks, not much, and we'll try and figure out if we're good for each other. My very best to you guys. Bye-bye now.